complex charts, numbers, news media always pumping headlines like Elon Musk lost 34 billion, Larry Ellison gained 40 billion in just 3 weeks. Everything sounds complex and confusing, right? The stock market.
If that's you, then this video is for you. Hey, the stock market isn't as complicated as it looks. In fact, it's super simple. And in this video, I'm going to explain it all. What exactly is a share? How does the stock market actually work? And most importantly, how can you use it to your advantage? I'll also show you how to buy your first share. So if you're a beginner trying to understand the stock market, you should definitely pay attention because this video is really important. Ready? Let's dive in. If we want to understand the stock market, we need to think in terms of systems. Let's take Apple Company as an example. It's a huge system, right? It serves great products to its customers, and at the same time, it generates solid profits for its owners. Now, to understand stock market, imagine taking that big system and dividing it into 1 million tiny pieces. Those pieces are called shares. That's it. It's that simple. Nothing complicated. If you own some of those share pieces, congratulations, you're now a shareholder of the company. You've just bought some small pieces of a system, and that's what people mean when they talk about stock market. You hear it all the time on the news, and now you know what it means. It's just a small piece of a bigger system. A single share of Apple was around $205 when I was recording the video. In the real world, a company like Apple is divided into billions of share pieces. These shares are owned by different types of people and institutions. Retail investors like you and me, big companies like Vanguard, BlackRock, company insiders like Tim Cook, the CFO, and other executives. Even some governments own a portion of these share pieces, but in the end, they're all just owning pieces of the same system. Let's take Tesla as another example. Elon Musk owns around 12 to 13% of Tesla's stock, and the rest is owned by other investors. So now, you understand what a share is, and you also understand the ownership dynamics inside companies. Now think about this. Instead of just looking at one or two companies like Apple and Tesla, imagine taking hundreds or even thousands of companies together. Those companies are divided into millions and billions of share pieces, and people are buying and selling those share pieces every day. That's what's happening in the world of stock market. It's just a market, like a market for fish. But instead of buying fish, people are buying pieces of companies, and it's happening all around the world. Okay, sometimes you'll hear terms like S&P 500 or NASDAQ 100 in the news, right? What do they actually mean? I'll explain that. It's very simple. The S&P 500 is just a collection of 500 big companies in the US. Companies like Apple, Microsoft, Nvidia, Amazon are part of the S&P 500. So when you hear on the news that S&P 500 is up 1%, it means that investors are buying more share pieces of these top 500 companies. If it's down 2%, it means more people are selling their shares in those companies. That's what they're talking about when they say S&P 500 is up or down. Similarly, NASDAQ 100 represents 100 big companies in US, mostly focused on tech and innovation. And this kind of thing doesn't just exist in the US. The UK has the FTSE 100, India has the Nifty 50, which tracks the top 50 companies in the Indian stock market. So what are these names? They're called indexes or indices. They give us a snapshot of how groups of companies are performing in a country or a certain sector like technology, pharma, banking, etc. Now I hope you have a clear idea of what a stock market index is. Ever wonder why share prices move up and down like a roller coaster? I'll explain that. Let's take a simple example. Imagine a store that has only one washing machine, just one. Now, two buyers walk in. One is just an average guy named Joe, and the other is Elon. The price of the washing machine is $350, set by the seller. Joe says, "I've got the money, I'll buy it for $350. But Elon says, "Hey seller, I'll pay $500 for that machine. Please sell it to me." Now what just happened? Elon pushed the price of the washing machine from $350 to $500 simply by offering more. This is exactly how share prices rise in the real world. When buyers see value in a company, they're willing to pay more, and that pushes the share price up. But if fewer buyers find the share valuable or they don't want to pay the current price, the share price goes down. In our example, it was just 2 people. But in the real stock market, there are millions of buyers and sellers constantly negotiating, constantly moving prices up and down. And that's how the stock market price moves. It's not magic, it's just people fighting over value. If a company is consistently making good profits year after year and expanding its business, that's naturally attractive to buyers, so they buy more of that share so the price goes up. But if the company isn't making good profits or is slowing down, nobody wants that share. Sellers willing to sell at low price, so the share price tends to fall. Some other things also affect stock prices, but those effects are usually temporary. Things like war, pandemics, like a virus, or even when big names like Elon Musk or Tim Cook say or do something dramatic. I remember one time when Cristiano Ronaldo moved a Coca-Cola bottle aside during a press conference, and the stock market reacted. Coca-Cola's stock dropped briefly. That was crazy, but remember, those are just temporary movements. The market may react for a moment, but it eventually returns to its original path. So don't panic for that. I've found 2 powerful ways the stock market can be extremely useful, and I'm going to share those with you in this video. The first one is buying dividend stocks, and the second is holding stocks for long-term gains. Let me start by explaining dividend stocks. When a company like Apple makes a profit, they share a portion of that profit with people who own their shares. This payment is called a dividend. Let me give you a real-world example. There's a company called Pfizer in the US. They sell pharmaceutical and healthcare-related products. At the time of recording this video, a single share of Pfizer was priced around $24. Pfizer has had an average dividend yield of around 4.31% over the past 5 years. So what is dividend yield? Pay close attention here because this term is super important. Dividend yield is the percentage of the company's share price that they pay out to investors as dividends every year. A higher yield usually means the company is paying a good portion of its profits to shareholders. If the yield is low, it means they're keeping more profits for themselves, possibly to reinvest in growth. You can check a company's dividend yield on Google or Yahoo Finance. Personally, I consider a dividend yield above 4% as solid. So, let's break it down. Pfizer has had a dividend yield of around 6.78% in recent times. That means if you own 1 share of Pfizer, you'll receive a dividend of about $1.63 per year. If you own 10,000 shares, you'd receive $16,300 per year. That's about $1,358 every month, without doing any work. That's the beauty of dividend stocks. The company's executives do all the hard work, running the business, while you, as a shareholder, get paid just for owning the shares. But there's a catch. To own 10,000 shares, you'd need to invest around $240,000. That's a large sum of money, yes. But if you have access to that kind of capital, dividend investing can be a powerful way to build passive income. Now here's something to think about. Dividend stocks are like owning a rental property, but without the headaches. With a rental property, you have to deal with tenants, collect rent, do repairs, and manage everything. But with dividend stocks, you don't deal with any of that. You buy the stock, and if it's a good company, the dividend just gets credited to your account. No effort needed. If your goal is financial freedom, dividend stocks can be a great tool to help you get there. But before you buy any dividend stock, do your homework. Make sure the company has a strong track record of paying dividends. Look at the last 5 to 10 years' history. For example, Pfizer's average dividend yield over the years has been around 4.31%, which is quite solid. Check the company's debt levels, avoid companies that borrow too much just to pay dividends. Make sure the business has great products or services and a future-proof model. And one last thing, diversify. Don't just buy one dividend stock. Spread your investments across 5 to 10 or more solid companies. If one fails, the others will help support your income, like having multiple income servers running in the background. Yeah, that's how you do it with dividend stocks. Now you've been exposed to a real money tree. Another way we can use the stock market to our advantage is by holding stocks for long-term gains. We all know that the cost of living keeps going up. Grocery prices are increasing, housing prices are climbing, eating out is getting more expensive, and even your morning coffee costs more than it used to. But here's the truth. While everything around us is getting more expensive, the value of the money we earn is slowly decreasing year after year. So how do you protect your money from losing value? One of the best ways to protect your money's value is by investing in the stock market for the long term. It helps preserve and grow your wealth over time, especially as a hedge against inflation. Let me give you some real-world examples. Pay close attention here. Did you know Apple's stock price has more than doubled in the last 5 years? In 2020, Apple stock was around $91. By 2025, it reached about $205. That's a 125% increase. And it's not just Apple. Look at some of the biggest companies in the US, like Amazon, Meta, Microsoft, Nvidia, and Walmart. Over a 5-year period, all of these companies have seen strong growth in their stock prices. Now imagine this. If you had invested $10,000 in 2020, here's what your money could look like today in 2025. These are real numbers. Let's start with Apple. If you had invested in Apple, your money would have more than doubled. An investment in Amazon would have given you a 50% increase. With Walmart, your money would have doubled. With Microsoft, it would have doubled as well. If you had invested in Meta, your money would have tripled. And with Nvidia, your investment would have grown by more than 1,000%. This isn't rocket science. Just by putting your money into well-known, strong companies, your wealth could have been protected and even grown despite rising inflation. I've noticed that a 5-year investment period works well for stocks. If we hold a good company's stock for 5 years, it's likely to grow significantly. Use Google to check your favorite company's growth over the past 5 years. So instead of letting your money lose value in a regular savings account, you could have converted that value into stocks and watched it grow. Because when you hold stocks, you're not just saving, you're preserving your economic energy in the form of real, appreciating assets. That's how you protect your wealth from inflation, and sometimes you can even make really good money doing it. Let me give you some tips for smart long-term investing. So before you invest in any stock, ask yourself these 3 questions. First, are they selling great products and services? This is super important, because if a company delivers poor products or bad service, it won't last, and neither will its stock price. Companies with bad offerings usually struggle to grow or expand in the future. So always make sure their products and services are genuinely valuable. Second, are they taking good care of their customers? Customers are the #1 priority in any business. If customers are treated poorly, the brand won't survive long, no matter how big it is today. A loyal customer base is the foundation of long-term success. Third, are they innovating or discovering something new? Do they quickly adapt to change? Pay close attention to what the founders and CEOs are doing. Innovation is a strong indicator of future growth. In 2007, Steve Jobs launched the iPhone, a revolutionary product. Jeff Bezos built Amazon by recognizing the potential of selling products online. Nvidia innovated the use of GPUs for artificial intelligence. Laying the foundation for modern AI, breakthroughs like ChatGPT-4, Gemini, Sora AI Video, and Tesla Autopilot wouldn't be possible without NVIDIA's GPU technology. So, these principles are very, very important if you're investing for the long term. Don't get distracted by stock charts, technical terms, or market noise, and don't fall for temporary hype or fear. Stick to the fundamentals and think long term. Now, I hope you understand the most important things about stock market. Now I'm going to teach you how to buy your first share. If you want to buy a share, first you need to understand where companies are selling their shares, where they are listing them, okay? Think of it like this. A fisherman sells his fish in a big fish market, right? He needs a place to sell his fish. In the same way, companies list their shares on a big market, and in the US, There are two main stock markets. Those are NYSE, New York Stock Exchange, and NASDAQ. These are the markets where companies offer their shares to the public. But here's the thing. Common people like us can't directly enter these stock markets. Only stockbrokers are allowed to place buy or sell orders there. So, if you want to buy a stock, you have to go through a broker, you give the order, and they do it for you. Some of the most popular brokers in the US are Fidelity, Charles Schwab, Robinhood, E-Trade. These brokers act as the middlemen. They're the ones who are officially allowed to buy and sell in the market. These brokers are usually regulated by FINRA and SEC for safety. Brokers also maintain your stock account. That's where your stocks are held safely. So here's what you need to do. If you want to buy your first share, set up an account with one of these brokers, deposit your money, buy your first stock, and start your investing or your dividend journey. That's it. It's super simple. If you have a question about anything, you can always contact your broker for clarification or check their website to learn more. Thanks for watching this video. I hope you found it useful.